everybody loves talking about banks and the potential of the banking sector, but there's an equally, if not more important aspect to the non-banking finance company sector with respect to the economy. And we have the best possible speakers to discuss that further. I want to take both the gentlemen to the first question that I have lined up for this panel, and that is with regard to the emergence of this sector. NBFCs have always, I mean, they've been around for more than 40 years, if I'm not wrong, and they've always played a significant role in terms of intermediation of credit, better dissemination of credit. But over the years, the role has grown bigger. So I want to get both your views on how that has changed in the last 40 years. Mr. Ivanka first, and then Rahul next.
Yeah, thank you. I think if you look at the way NBFC have grown over the period, NBFC used to be very asset-specific companies, right? Geography-specific companies, highly localized, and they started with the vehicle financing as hire purchase loan, hire purchase agreement kind of a company. And now it has grown big with gold financing, house financing and mortgage financing, SME financing, many segment getting added over the period. Even though there were traditional lenders who were doing SME separately, shops separately, the ecosystem was there, but it has grown big now. We are growing at around 20% year on year, when overall credit is growing anywhere between 12 to 15%. That means NBFC is growing faster than the overall credit. And the share of NBFC, which used to be around 11-12% around 7-8 years back, today it's around 20%. That means a significant large role NBFC are playing. I think the way NBFC have a corporatized governance, ability to raise resources, bring in more equity, and the participation from the FIIs and maybe venture VCs and Ps, that all have made it possible to make this happen. I think the only advantage what NBFC bring in is we go to the customer. NBFCs typically have an approach of going to the customer,
right?
Whereas typical bank would like customer to walk into the bank. There is a totally different approach. And because we create an opportunity to go to the customer and try to find out what he needs and meet his requirement, we are growing a little faster. And I think we are complementing the system. I don't think it is a competition to bank. No way we try to say that we are competing or trying to take a market share from the bank. It is not necessary, not needed. We are only creating that comfort, because as more financial inclusion happens, as there is more organized credit getting distributed or disseminated or underwritten for the benefit of the overall customers ultimately will benefit.
Okay. Rahul, your views on this?
Thank you, Vishwanath, and thank you, BQ team, for having me here. So I would agree with Mr. Umesh in terms of NBFCs actually created new categories and kind of refined the playbooks for banks to participate in certain categories. Clearly, auto loans is one example. Within auto also, if you look at tractor lending, right? PSU banks had stopped lending at a period of time. But then the whole playbook of NBFCs ushered in a whole new way of doing tractor lending, a new category in the form of microfinance lending. I mean, the whole NBFC, MFIs created a category. In my last job, by the way, I was in a bank for 20 years and last 2 years in an NBFC. So we were able to use a lot of these playbooks created by NBFCs and now expand that horizon. And we can go on gold as a category, SME as a category, even maybe educational loans in its new avatar. So I think very clearly, to the point that Umesh made, creating new categories and resetting new categories and creating a sustainable playbook is what NBFCs have done. And going forward, as we look at the headroom for financial intimidation and the whole uncatered segments which are now getting into the fold, I believe NBFCs might have some challenge purely with the arbitrage, cost of fund arbitrage. But RBI again has come to the rescue in very progressive kind of structures of co-lending, co-origination, etc., which makes it possible even for NBFCs, if they can't bring maybe their balance sheet to the table, but bring distribution to the table, which is overall good. And it stitches into the point, what are those kind of partnerships that mainstream financial players can get into to actually proliferate financial services. So I do think, in a nutshell, been an important constituent. 20% of the whole, share of lending, driven certain categories, continue to be at the forefront of technology adoption. And now it's a good time for looking at partnerships and collaboration.
Okay. I want to get this out of the way earlier than later. The one sort of difficult period that, as far as NBFCs is concerned, of course, COVID was difficult for everybody. But specifically for NBFCs, the IL&FS crisis of 2018 was the one period where everybody had started building a sort of a negative view on the sector itself. Even though, vast majority of the sector they was not involved in any of that, neither were they accused of any of that, but still there was a generic view that NBFCs may not be possibly trusted, at least at that point in time. I want to ask you, how is it that when it comes to the borrowing market, when it comes to your own borrowers, as well as your lenders, people who extend you the funds that you can do business with, changing this sort of viewpoint away from IL&FS and bringing it close to what your business is doing? How did that sort of evolve in the last 5 years?
See, the challenges faced by NBFCs are, every cycle you have certain challenges. It is not that this was the first time we faced a certain challenge. Sure. Right from my 3 decades plus career, I have seen. So what happens is, whenever there is some kind of economic ups and downs, people do feel that the borrowers who are in the lower bottom or in the small and medium and maybe the individual borrowers, they will default first.
Yeah.
And if they default first, the lenders will get affected. So this is the kind of impression people do have. But the resilience of our customer, that makes us stronger. It is not our own resilience that matters much. It is the resilience of the borrowers that is really helping us. That's first thing. Because of them, we are able to, get our money back and service our loan. Then, of course, you have the other side, where is the liability side, where certain market will suddenly become cold to you. So we have a multiple borrowing lines.
Yeah.
Bank you have capital market. Sometimes you also have international capital bonds or markets, and you have deposits. Both of us are deposit-taking NBFCs. But one thing I have seen is, in all these crises, the depositors have always stayed with us.
Right.
And we have never seen a depositor having a loss of confidence on us, because maybe we are there for quite a long time. We have been servicing them. So that's one very positive. Banks have been reasonably supportive. And even the regulators have been consistently supportive of well-run NBFCs. The one market that gets suddenly a little cold is a capital market, because there is immediately there is some kind of a vacuum there. That's what happened during the IL&FS, even in the COVID. That particular market was virtually non-existent, closed for us. Then you have other avenues to manage it. So ultimately, it is a balancing between having a multiple source of resources as one that makes you strong, and deposit taking is definitely strong for the NBFC like us, the larger NBFCs. Then, of course, the resilience of the borrowers who are able to manage the crisis and pay the loan, if not on time, at least delayed. So I think that helps NBFC. And because of our relationship with them one-to-one, so ultimately, we are able to connect with everyone, whether it's a borrower and or the depositor. Our ability to connect, having a reach, having a branch, from the beginning, building that relationship model, all these things have helped, by and large, the NBFC sector.
Okay. Raul, you were on the other side during this crisis, but how did you view it then, and has it changed since?
I think they always say you shouldn't let a crisis go waste, and you learn a lot from crisis. But I echo what Mr. Revankar said. I think whether it's on the liability side or the asset side, how do you really get a bit more formidable here? On the liability side, yes, deposit taking NBFCs are slightly better placed because when lines get crunched, if you've built a decent granularity in your liability base, you're better off. But I think when I look at my organization, I just view of what really happened. I think the whole focus on compliance functions, audit functions, risk functions, I think that really took a step up because the regulator was expecting also after that NBFCs also pretty much have these functions which are akin to a bank, right? And when I look at the maturity levels of these functions post maybe the ILFS crisis, I think that's really taken a big step up.
Yeah.
So for me, that's been a good reset of sorts, specifically like a risk function, right? In NBFCs, which you would say erstwhile an underwriting or a credit function would oversee, but having a separate risk function and the kind of overview it has on every element of risk, whether it's op risk, market risk, credit risk, etc. I think those functions really took a step up. But otherwise, I'll be repeating whatever Umesh said, and I completely agree. Those are learnings from a crisis that NBFCs have incorporated.
Coming from one crisis to another during COVID, right? So this was a period where the core of your business, which is reaching out to the customer, you said that that's something that the banks did not do. Banks expected people to come to the branches. So you go to the customer. That was stopped, right? For a extended period of months on end, you just could not reach the people that you are supposed to deal with. Coming out of that, did it change anything on the borrower side or your relationship with the borrower? Did it change anything at all?
In fact, the way we operated was totally different. First 21 days, definitely none of our offices were open, and we started communicating to them over phone, customers, trying to ask them well-being and all.
Yeah.
So we did not really try to push on the EMI collections. But the second month, post 21 days, I said, if you can open our branch, if you can visit our customers, if you can meet them, we should start doing it. And we started opening a branch wherever it is convenient and possible. We also start meeting the customer, even though we had social restrictions. What we did is we met them in a common place, like petrol bunk, a medical store, or grocery shop, and try to, because we wanted to encourage our truckers, especially truckers, tractor owners, and vehicle owners, that you can operate. Because you are essential to the economy and you are essential to the community around today. Your movement, because only when the goods get supplied, your economy will continue to thriving. People can have milk or their groceries or whatever is possible today. It's only because of the transportation that was continuing.
Yeah.
So this encouragement we tried to give them. Because there was definitely a pushback from their own families. Why are you going? Don't go. Your health is important. You are more important. Yes, but you can take a precaution. We supplied the free mask, free whatever the required to protect themselves. We supplied them, and we said that you can do, and you are now able to. In fact, it's more viable to do business now. You will get better earning. So we encouraged them, and that made us continuously be in touch. So we were never out of touch. And we introduced a novel method of pushing the your SMS for collecting a payment. And everybody adopted. See, even a vegetable vendor, you would have observed.
Yeah.
He started using QR code for collecting money, no cash. So people moved, every businessman moved. And our collection also started happening in the second month itself.
Yeah.
Even the moratorium was given for 5 months. I think the percentage of people who really used the moratorium was coming down every month. So hardly only the tourist buses or maybe office buses which was ferrying the employees, only there the moratorium was fully used because they were not flying at all. But the rest everything got normal in the second or third month. And we were all working virtually. So even though we made the social distancing, all those things now, we kept advising our employees what to do, what not to do, never visit a home. All those things we did. But I think every other NBFC would have adopted a different method. But we did this, and I think it's quite a great experience going in and out of it in a very successful manner.
Rahul, has anything changed post-COVID for Mahindra Finance?
No, absolutely. I mean, I joined in the thick of the crisis. I joined 2 years back, so it was actually the second wave. The first wave did not disrupt really so much because there was very generous restructuring, moratoriums, etc.
Yeah.
But if you remember, the second wave really disrupted the informal segment much more than the first wave. And just to contextualize it, Mahindra Finance hit a 16% NPA at that point of time. And there were questions on the business model, etc. I think, to what Mr. Revankar said, you first of all have to have conviction in your own business model. You have to have conviction that your consumers, your customers are disrupted. It's not the fact that they have become intentional defaulters. There is a disruption, etc. I think in reflection, what we have done since then is realize that when you're of a certain size, you have to have a meaningful amount of diversification. I'll just expand on diversification. Both of us are very heavy auto players, right? 2 years back, Mahindra Finance 60,000 crore portfolio, 97% was only in the auto space.
Yeah.
Of course, three-wheelers upwards, but that was our exposure. And the question at that size and scale, can your fortunes only be linked to one industry, because the disruptions and the cyclicality of those industries then hit you so much harder. So one thing we learned is that at this scale and size, meaningful diversification is a must. Today that 97 is down to say 93. Within your customer segment also, we were typically a financer to the very semi-urban, rural, self-employed, non-professional customer segment. Now that customer segment again gets much more, the stress gets that much more amplified. And when you're an auto player, you can decide also to bring in a slightly more, less volatile customer segment. So today, we have 15% of our consumers who we call Primex customers, right? So diversification in customer segment, diversification in asset category is one lesson we learned. Number two is to the point again on the dependence on branches. If you're an NBFC who's totally dependent on the branch, wherein if there's a local restriction and your branch closes, you can't engage with customers. And then you realize as normal BCP, as keeping maybe an omni-channel kind of a presence, making contact centers or centralized offices. So now that's got also set in place. If a branch closes or a local administration shuts down an area, I don't think everything comes to a standstill. We've realized how to operate in a more agile and omni-channel manner. And lastly, I would again link to a point that Mr. Revankar made. I think the crisis taught us how to step up our own empathy. How do you interact with customers? How do you really realize, partner them not just in good times, but partner them in bad times? Do you really kind of understand each customer persona, what kind of stress they've gone through, and also empathy to your employees?
Yeah.
So I think these were three big lessons which are invaluable and have helped.
This leads me to my next question, thankfully. Thank you for pointing me towards it. But the question is, when you're dealing with a customer base that is one bad day away from not being able to repay the debt, right? Or they're very prone to disruption of any kind that happens out there in the economy. Probably the first to get hit. When you're dealing with a customer like that, how do you build a profitable business on top of that? Because anything could sort of lead to a high default rate.
See, in my experience, what I have seen is in this kind of a customer, they're not as vulnerable as we think. And because they're all having an asset that is backing them, that is earning for them.
Yeah.
So whether it's a vehicle or you have machinery, whether you have a shop, something is there for them to earn. So that's the one plus point. The second is, in the worst of worst, if the breadwinner is no more or having a serious health issue, then only the customer will be in a default. So I would like to differentiate between delayed payment and default.
Yeah.
Because the delayed payment is something which we can expect at this particular level, because they have a cash flow mismatches in their business. Whether it's a vehicle owner or shopkeeper, one bad day or some strike or something, you do have cash flow mismatches, or what to get as a credit and what to give as a credit. If there's a mismatch, also you have some cash flow mismatches. There is big delay. A delay doesn't mean default. See, the NPA is very strict. It compartmentalizes you. But if you look at the customer, there will be a customer who would have paid 4 months delay, but happily completing the loan. See, as long as he completes the agreement value and loan and paid the late payment interest, we are quite comfortable. It need not be, it may be in the eyes of the accounts and maybe in the regulator norm it is NPA, but it is not NPA. So delay doesn't really bother us. The intention or something happening to the breadwinner, that really bothers us. So that is a small percentage, and that will remain a percentage as long as you manage it. If you should be able to deal with it, manage it. I think we are with since it is divided between so many people, individuals, we have no risk of having a big NPA in one particular account.
Yeah.
And therefore, I think we are very comfortable. NBFCs are generally a more comfortable situation because of the small ticket, well distributed among a high number of people is what I believe.
Okay. Now, does the volatility worry you at all?
See, there's a reason why our NIMs are equal to the lending rates of banks, right? As in, we do get in customers who have a certain element of vulnerability, which is higher, and that's the business model. But I did mention, our NPAs went up to 16%. Today they are at 4.2, 4.3. Now, one needs to, besides looking at default and delay, also look at ultimate credit cost. While NPAs might be high, the ultimate credit cost is a good reflection of really what is the vulnerability of the model.
That is just for your interest rate, the charge that you're taking. Yeah.
Exactly. Yeah. So if your business model can have the appetite to subsume that, then clearly, you're on top of at least the predictability on the range of default. And, we talked about how COVID taught banks and NBFCs how to be more resilient. But I think when, we have, in the 6 lakh villages, we have a customer in 4 lakh villages of the country. When we look at what has changed since then, I think there's an element of even diversification in their incomes. Many customers who were primarily single source of income have realized on how to kind of within their households diversify their income. Whether it's a dairy income, whether it's sending somebody out to do some remit from an urban to a deep geography location. So that has happened. It's a good sign for us. We are able to build that amount of diversification in their incomes and get that kind of repayments. But even the whole UPI stack, and we don't really have to go. I mean, we used to collect 70% cash. That is today only 30%. So consumers know that if there is money in the account, they can conveniently pay it back. Earlier, to travel 10 kilometers to a branch to pay was inconvenient. So whoever turned up first, the moneylender turned up first, would be paid first. So I think there have been structural shifts, one in cash flows of these customer segments, two in the ability for them to pay. And three, I think RBI has also pushed us. See, we were happy with collecting before 90 days. Now RBI says, it's not end of month, it is on due date.
On due date.
So that amount of push also brings in an element of seriousness within your organization. And all of this put together reduces the volatility. And I think it's come down. It's not that it's completely gone, but for our business model, I think we factor it in the overall ranges.
Okay. I want to touch on the regulatory part a little bit, but before that, we'll talk about this technology side of the story. Now, right before this panel, before lunch, we had a discussion on bank tech. I understand banks and technology and how they're pushing it now, but in your business, which is a high-touch business, right? The role of technology, as you said, UPI helping you improve that collection because people don't have to make that trip to the branch. But can technology replace the high touch model, or is it only an enabler for it?
For us, technology is a tool and enabler, and it will remain that way. And there cannot be something like totally impersonal transaction in finance. That's what I believe. Totally impersonal is a highly unlikely model that can be scaled. It can be developed in certain segments, but it is not possible to really, maybe there will be some attempt to do it. but there will be at least for follow-up or some reason you need to have human intervention. So that is going to happen. So when does the human intervention happens? In the beginning or end or in the middle? It all depends when, but it is there. So we believe technology is a great enabler, and also it's a tool. As a tool, it helps you to underwrite better. It helps you to understand the customer's other source of information and income better. And as an enabler, it helps you to reach out to the customer. It helps you to recover much faster. It also helps in productivity gain. I gain a productivity because I did not go to him to collect cash, and I did not bring it, count it, put it in the bank. And customer, he need not come to my office, spend half a day. Because even in many of the places, if he has to reach to the office, he has to park his vehicle somewhere, because most of the time he's owner operator.
Correct.
And he wastes one day or half a day. So huge productivity gain. So I treat the technology or digital or fintech, all those things are great productivity enhancer for both company and for the customer, and it has really resulted in one of the reason I feel the improvement in our asset quality. I attribute it to the technology and high use of technology or digital mode by the customer and the company.
Rahul, the beginning of this discussion, or the beginning of the day, we had a discussion with two senior bankers, and they were priding themselves on the fact that people are no longer carrying wallets, they're no longer coming to branches. It's a great thing, because now reach and distribution is no longer a differentiator. To your mind, can that happen in the NBFC sector as well?
See, if you're largely catering to one prototype of customer, that's possible. I mean, of our 2.2 million customers, we have tractor customers who really get intimidated by digital, right? And then you have someone who's buying a XUV 700 who really doesn't want to even walk into the showroom. They're happy to go to the metaverse, check the vehicle out and check out by taking finance, or go to a car and bike and do that. So when you're a versatile player, I think it's important to understand the digital maturity of your customers. There could be a customer who doesn't want to walk into your showroom, but he wants you just to be available on the marketplace, have a good feature, and then choose you while they're checking out from their primary product. But at Mahindra Finance, with the versatility of our customer segment, we've decided to become the most sophisticated, digitally mature company, but render that those tools which is akin to the digital maturity of the customers, and not intimidate customers just because there is video KYC kind of force-fitted on a customer segment. So it's important to marry the two, the digital maturity of the customer, and also, I think, speed track the whole digital maturity of your own organization, and we are on that journey. But does it mean that you do not also influence the digital maturity of your customers? I think I wouldn't say that. If there is, say, for example, a customer is intimidated by video KYC, there is eKYC. Right? A tractor customer can still save your cost of acquisition by getting onboarded using eKYC. Today, we know account aggregators there, and we know digital payments is there. So I think lenders have to be sensitive to how they kind of unlock these digital toolkits for customers. It's very fancy to say we're a full digital lender, and hey, we will not just automate a physical process and call it digital, because it might sound fancy to say that, but I think you have to be empathetic to where the customer is in their journey and try to prod them to come up the scale. I think earlier there was physical, phygital, digital, but Mr. Uday Kotak coined a new word last time called digital, which is a form of being digital first and adding the physical leg. And lending, in my mind, except for maybe personal loans where you can do it end to end, RTOs are not digitized. Only one RTO in the country is digitized. So we'll have to be aware of all the omni-channel experiences and kind of get to that maturity along with the way in which the ecosystem is maturing.
Yeah, I mean, we had Shanti Kamram who also pushed this digital term, but I wanted to now get into the regulation side of the story. So the RBI introduced this scale-based regulatory system where, depending on your size, the severity of the regulation changes. Now, you are both treated as equivalent of a bank in terms of the regulations that apply to you. Does that affect NBFCs as a business? Because you are different from banks, but if you're going to be regulated like banks, then does that impede your business at all?
On the face of it, it may look like a regulation is same for both NBFC and bank. And being in the top layer, yes, it is almost like a bank. But if you really understand the regulatory aspect, since we are quite large and systematically important to the financial ecosystem, RBI wants to treat us on par with the bank. So otherwise, the advantages being a NBFC or advantages or being a bank, they are totally different. For being an NBFC, you are a segment focused, you are customer focused, you can design your product much more faster, you are nimble footed, you can do things much more frequently and adapt yourself to the need of the customer and customize the product. In the bank, I think it will be a little challenging to do that because, as I was explaining to you in the beginning, as an NBFC, we are focused on more customer focused. And in the bank, I think it will be the other way, that the customer need to adjust to what bank wants or other bank condition wants. So it will be a little different. So we are very comfortable as an NBFC, even though the regulatory supervision or arbitrage is not there. And we never became NBFC because of arbitrage, first of all. See, none of the NBFC decided to become NBFC because of arbitrage. We did not look at that as advantage. We looked at the customer segment as an advantage. We looked at the margin there available as an advantage. We looked at the convenience of being NBFC to distribute or underwrite the product as an advantage. And those advantages still remains. So I think beyond that, I have nothing to say.
Okay. Rolf, this arbitrage question I wanted to ask you. Is this still relevant? Because we've seen what happened earlier this year. You've got a large housing finance company merged with the bank that they created. The reason they cited was the arbitrage has gone away. There's no reason to have these two entities. But does that still come into play with the regulatory mechanism that is in place?
See, the grass is always green on the other side, right? And but just to put facts on the table, on the liability side, there's nothing as attractive as CASA to kind of get your real cost of funds down. But look at a lot of banks who have come in. How big is their CASA today? It takes time to build that franchise, and it's good to say that CASA is a great part of your liability mix. But then, as an NBFC, when I look at the CRR, SLR, PSL, these are all, we are not handcuffed with all those kind of stipulations. So I frankly don't believe there is too much of arbitrage. There are pluses, minuses on both sides. When you consolidate it, it pretty much is formidable enough to be in the skin of an NBFC or a skin of a bank. Maybe when scale hits a certain size, right? I mean, we'll be about 1 lakh crores by end of the year. I don't see, at least for the next 2-3 years, wherein our business model is challenged because we'll be in the skin of an NBFC. Because there are benefits being on this side, the versatility. Of course, some of the regulation is blurring with the upper layer, as you mentioned, 15 of us. I think that amount of regulation is blurring. But this is good. I think we welcome regulation. It just gets you to be that much more sane in your practices. It gets you that much more compliant. And in a nutshell, I think it's not in any way devoid of being competitive on the marketplace with mainstream banks.
Okay. I want to ask one last question and then we'll move on to some of the audience queries that we have. But my last question is in terms of the role of NBFCs in this growth cycle. We've discussed that at length, but what are the potential challenges that you're looking out for? Because there is a growth cycle coming for sure, and it is as effective for you as it is for any bank out there. But what is the challenge that you're seeing that you probably should watch out for?
See, in India, only two things which I really feel a challenge. One is the drought for 2 consecutive years, virtually having a challenge on rural economy. Because rural consumption and population is large. Population is 65%, consumption is 45%. And that can have an impact. That's one area which we are lucky enough in the last 5-6 years, we never had, even this year, even though it is erratic, the monsoon has been reasonably good, except for few geographies. So we have been lucky. India has been lucky in that matter. So that's the only one challenge I see from the external. The internal is basically it is the what you call regulatory interference sometimes can have challenge on the NBFCs if there are forced changes, but I don't see, because RBI has been very consistent for the last so many years. They have been guiding us consistent, whatever they have done, 2-3 years advance they have been telling us and moving. So I think there has been quite a good help and support from the regulators. So these two risks I don't really see happening. Therefore, I don't really see a challenge unless Indian economy or Indian GDP growth comes down below 6%. So otherwise, I don't see any challenge for NBFC.
Okay, Raul, your view on what is it that NBFC should probably watch out for if they're going to participate in the growth cycle?
So we are seeing a good kind of run so far. It's been a pretty benign risk cycle for quite some time. You would have heard some folks making comments on unsecured lending is starting to see a little bit of heightened risk. We are also seeing El Nino and kind of commentary, because while up till July we had decent rains, August was quite a bummer.
Yeah.
And thankfully September has kind of crawled back. We've seen some decent amount, but if monsoons, which still there is time for us to kind of call that as deficient or decent, it does impact rural sentiment. While you might say reservoirs are decent, but rural sentiment is largely guided by monsoons. So I would say the whole way in which this plays out is important to watch for. The unsecured surge over the last couple of years, the overall leverage in households, I think that's a matter of maybe we'd have to look out for that. Both of us are largely secured, so we might have less stress. But if a household is leveraged, that is stressed.
Yeah.
And of course, we expected interest rate cycles to at least start seeing some decline, but we are not really, you're seeing where kind of inflation is. Yeah. We're seeing crude is at 90. People are predicting some levels of crude going up. So for us to have had maybe a little bit of relief in the third, fourth quarter in terms of names, in terms of overall ROAs, those are, I would say, the 2-3 challenges that we see right now. And of course, some long-term leverage would be what I would call as something to watch out for.
All right. So before you two came in, we had a question that was passed on to some of the audience members here. It was a sort of a 4 responses based: strongly agree, disagree, or strongly disagree. The question here is: have you fully overcome the negative sentiments after the IL&FS crisis and are set to tap into the new growth cycle? Now, more or less, it's split between the agree and disagree path. I know you said that you agree with this, but how confident are you of this new growth cycle and tapping into it to the best of your ability?
This new growth cycle looks very fundamentally strong. One thing is there is a strong foundation on the infrastructure. Our government is building infrastructure continuously without slowing down. They're trying to make things happen. Manufacturing in India, they're trying to enable and make it happen. Maybe we are in the best of the time when the entire world wants to reduce their dependence on China, and something is moving into India. Even though it has not moved as fast as we expected, it is definitely, if the infrastructure is there, because as I know, all the developed economies, one thing they raised question on India was the infrastructure. They were wondering whether infrastructure will support any economic activity in India. But once that is in place, I don't really see any challenges. One thing is that, and second, the demographic benefit what we are having today is something which no other country in the world is having, not even China is having. So that is a big benefit. If only we skill train, make them eligible, or make them make them ready for the kind of work that is coming into India. I think that's the challenge we have. But otherwise, I think this cycle is likely to remain for a long time. And I personally, maybe people may think it is a wishful thinking. We can go do what China did 20 years back, having a 10 plus growth for 2 decades. China did, and that really took their economy 5 times more than India today.
Yeah.
So we can also have such a kind of a run if everything comes in place and all this infrastructure story plays out, the manufacturing moves in, these proper skill sets are being developed and provided. I think we should be able to have long bull run, not bull run, in sense long growth, nearly double-digit growth for India.
What about your view? Firstly, on the question, because
Quite a split house.
Split house is interesting to me because yes, people believe it, but they don't all believe it.
Yeah. So I just nuance it a bit further. I think NBFCs are a very large cohort, right?
Yeah.
I mean, if you even look at small, medium, large, I think that's going to play out. I mean, you'll see folks who are well capitalized, good distribution, might be able to ride this wave in a much more prolific manner. Those who are constrained by capital distribution, unless they do tie-ups or are able to leverage it something, they'll find it a challenge. But overall, I would agree the tailwinds of the whole infrastructure story, the tailwinds of a lot of formalization which is happening. We heard about frictionless credit with all the railroads of the whole India stack getting even more formidable, with now all land records getting digitized. So the opaqueness of a lot of the excluded segment, I think that's going to give NBFCs much more confidence to not just NBFCs, lenders much more confidence. And I think besides that whole personal credit, even if you look at enterprise credit, the whole medium micro segment, I know there are big bets with ONDC, these are big themes, but it all depends on how those also play out.
Right.
And they seem powerful enough for even the micro enterprises. Let's not forget that's as big a category as housing, right? And that's the most, I think, less intimidated right now in terms of financial penetration. If that whole micro segment gets more formalized, and NBFCs will play a big role, medium, small enterprises, banks play there, but NBFCs have been at the forefront of doing this. So I think NBFCs can ride this wave. Enough of macro tailwinds. We've just got to be sane in our practices to not do anything, which can derail.
All right, okay. On that note, I'll take a couple of questions from the audience if anybody has one. Gentleman over here, can somebody please help him with the mic?
Thank you for your discussion. You see, you are saying that you're very positive about the future and about the growth. But if you see the hard data, the rural real wage growth is not happening as per the data. That means agriculture and rural India, which is the bulk of at least our workforce, if they are having a negative growth in real wages, then it shows the sheer plight of a lot of people in this country. Plus, if you look at the labor participation rate in India, it has been declining. So the entire argument of the demographic dividend, it is proving in the exact opposite way. That means you're not getting quality employment taking place in India. They're going over to rural and agricultural India, which is really more disguised unemployment. So my question to you is, how can you therefore be so confident about the future being so bright when the immediate data of a large part of India is showing a very negative sign?
Yeah, see, the way I look at it is the rural wages not going up as much as the urban wages, and therefore the consumption in rural can come down. The economy may not be able to grow. Yes, to some extent, at the deep rural area, you are right. But many of these people have dual employment. Many of them work in a city, send money. So that is something I think is not captured in because if you go to UP, I meet a driver here in any of the cabs, you will find person is from either Uttar Pradesh or from the Bihar. Then I ask him, what is in your home? He says, I have a land there. Then why are you working here? He says, no, I have other brothers who take care of it. It doesn't generate enough cash. So I come here and work and I generate cash. So I think all these people, they have a dual income which doesn't get reported. So the consumption in the rural, whether it's going up or not, whenever I go into deeper pocket, I see all FMCG goods, which was not there 20 years back. You will see everywhere. All packaged food you will find across every shop. How it is possible to consume? Plus, and mobile. Mobile is one thing which we thought it will be urban luxury. Today, everyone is having a mobile and transaction in or data consumption or usage of mobile or whatever it is deep rooted now. So I personally believe there is a transaction between rural and the urban, and the money is flowing into the rural, and therefore the consumption there is reasonably good. I very rarely do see a total distress in the rural area the way it used to be in the past. Whenever there was a drought, I used to see people standing in the bus stop or railway station to somehow get into the city, get some mazduri or some kind of a job and live in the wherever possible in the city and make some earning. That desperation I don't really see, because I do travel between rural and urban area, and this is my observation, and I do talk to them. I do talk to them to find out. Their children are going to school today. They are getting medical facilities. So they are able to generate sufficient income is what I believe by working in both rural and urban.
Rolly, want to add?
You had a follow-up question?
Sales, the volume terms, the volumes of FMCG sales today are not at all inspiring. You see the volume of two-wheeler sales. So you are getting a very classic K-shaped recovery, where the bulk of your population, which is low income, is not doing well, while only the people at the top are doing well. So therefore, as an NBFC, should your business strategy be to evolve to cater to the people at the top, because the people at the bottom really are not seem to be doing well at all?
I'll just, add to, I don't think both of us meant that it's all hunky-dory. There are challenges for sure. I think when you look at rural, some of the markers that at least we look at as in if everything is, very gloomy, one big reflection is in collection efficiency that you see every month, right? And whether you look at microfinance companies, you look at NBFCs, I think that marker is not telling us that there is a very big crunch. Rural unemployment, I think the data is mixed, it's jumpy. I don't think there's one side of the, whether you can kind of tick it or kind of say it's compromised. That number has been jumpy. MSPs have been kind of going up. So, that's a big flow for the rural folks. But there is an element of difference, at least wherein, we as NBFCs look at how FMCGs look at it. Because a soap and a shampoo purchase, that decline, first of all, those markets are already some of them are at saturation level. Plus some of these maybe products are discretionary. When someone buys a tractor or someone buys a taxi, they are really doing it for boosting their household income. They're not looking at it as a discretionary spend. And, with the fundamentals, with road infrastructure improving, with kind of, haulage income improving, why would rural folks delay those kind of investments? Even classic example, Onam, which has gone by. Onam is a good marker for how the vehicle season will play out. And I don't know whether, what you've seen. We've seen a 12% increase from last year. So I would say largely the markers are not distressing. One could agree that there's a bit of a K-shaped happening. There is, of course, the affluent segment is growing at a much larger pace. That's why SUVs today are 60% of the vehicle sales. But yeah, at the bottom also, is it too distressing? I wouldn't really say that it is in a manner which is, getting us to be a bit defeatist or worry about not participating.
One point I would like to add, sir, especially you just look at, whenever I look at inflation worry, I just see the size of biscuit packets. Today, for 5 rupees, you get a biscuit packet. And 10 years back, that packet was almost double. But the size amount is 5 rupees. So your consumption by the rural, they'll reduce their consumption to suit the inflation. So rural will not overspend any point of time. If there is inflation, even in the shampoo or soap, I have seen people moving out from popular, highly advertised brand to local brand because they would like to match to their expectation budget. So rural India is highly sensible. They go with the budget. They don't have BNPL, they don't have credit cards. So therefore, their consumption is always a controlled, budgeted one. So if the consumption doesn't go up in the rural, it is a different story altogether because they're consuming it differently and within their budget. That's my observation. And I was surprised to see my son stays somewhere outskirts of Pune, and I just went there. He got me my wife wanted to make a tea. He got a milk packet, 10 rupees milk packet. I never imagined that there's a milk packet for 10 rupees. Because it was suited for that kind of a customer. Because they will use milk only when there's a guest. Otherwise, they don't use the milk.
Okay. Can we take another question if anybody has any? Gentleman at the end of the room.
While that comes up in rural, instead of BNPL, it's called SNPL, save now, pay later.
Hi, am I audible?
Yes.
Yeah, good afternoon to you. This is Tyagarajan from Vayana Supply Chain Financing. What's going to be the NBFC focus on supply chain going forward? There's been a major shift post-pandemic with banks as well as NBFCs focusing, but somehow or the other NBFC seems to be lagging behind in this space because always the rate card, the general market perception is, hey, I go to an NBFC, the rates are going to be more costlier than what a bank offers. But do you think going forward, your focus would be more razor sharp in the space, considering that it's the growing space?
I think interest rate is something which customer, businessman will not look at. He will look at the quality of the service, promptness of the service. For a businessman, every day counts. So I don't think the comparison with a bank and NBFC, and as I told in the beginning, we are only complementing the bank, our entire financial system. So there is no competition as such. If a customer has access to bank, he'll go to bank. Otherwise, we will service him. So that's how it will be. And going forward, that is going to remain in India because the credit gap is quite large to be addressed.
I have a quick supplementary question, if you may. Yeah, Alex, right here in the front.
Yeah.
So we've spoken over the course of the day of using various tools, information, data to change the way that banks underwrite. And I'm just wondering that in the space that you guys play in, which is kind of on the outskirts of what some banks play in, because the pool is so large, with so many people starting to use more digital products, does that change the way that you underwrite? And therefore the pricing, how does that change? I will supplement what he was saying. Obviously, your pricing is generally higher than what banks offer because the people that aren't catered to in the banking system move towards you. But then are you then, because of the data that you have and the underwriting capability that you will generate, will you be able to price it better?
So I'll take more of it if you're okay. See, on supply chain finance, there's a lot of formalization that's happened. There's this trade platform that have come out, a whole lot of other marketplaces. And I think just from a participant, I see when you look at upstream channel funding versus downstream, upstream, now the rates are so fine, it's tough for NBFCs to participate because it's really a very fine rate, right? But still, large NBFCs like us, where there is some assured payment, etc., we still participate. I think the real meat was in the downstream. And here's where formalization started because there was a lot of these FLDG kind of participations between fintechs, etc., and the digital lending guidelines caused a bit of disruption for some period of time. But now that it's out, it's starting to surface again. But I think the real meat for the micro and the MSMEs, for them to get access to finance would be in downstream, the small dealer, distributors, etc., etc. And there, the gentleman from Bayana asked the question. I think you are seeing alongside banks, a lot of NBFCs also come in now, since the whole digital lending guidelines on FLDGs, etc., got ironed out. But that is, in my mind, the biggest amount of space left for NBFCs to play. Upstream might be challenging. Plus, upstream in the regular trades platform, surprisingly, RBI still doesn't allow deposit-taking NBFCs to participate. So we are trying to get them to, oblige us to participate there. But that is a big, that'll be a big boost for NBFCs to participate, specifically downstream, as more and more data comes in, as more and more, granular kind of data points come in. To your point, I think the crux of your question was, is the whole availability of data going to reduce the, barriers for more folks to finance what we call the thin file customers, which NBFCs would finance? I think definitely yes. It becomes that much more competitive. But does it take away from the uniqueness of having that engagement? Because at the end of the day, you've got to also have that engagement, right? And I alluded to the point, not every customer wants to have that, very, very disconnected relationship with their financiers. They want to come, they want to sit. Otherwise, why is HDFC opening 500-600 branches a year? Because they know they have to be at the point of action. They know that along with the digital footprint, they've got to pick up a lot of other insights from customers. It's still largely a thin file customer. Your toolkits will have to evolve and split risks as you use those, digital footprints and embed them in your, algos, etc. Is it going to speeden the kind of participation of mainstream lenders in rural and segments which were hitherto not participated? I definitely think yes. Will it make folks like us more efficient? Definitely yes.
All right. If there are no questions, I'll move on. Okay, that's it. We're done then. Thank you so much, Mr. Remakar and Mr. Bello, for joining us on this conversation.
Thank you.
It was a pleasure having you here. Thank you so much, guys.